Why 90% of traders fail, even with a profitable strategy. Most traders believe that if they can just find the right strategy, everything will finally fall into place. They believe that once the strategy is profitable, success is guaranteed. They believe that the market will finally start working in their favor. But the reality of trading is very different. This belief is one of the main reasons why 90% of traders fail, even when they are using a strategy that actually works. If you have ever followed a strategy that looked perfect in backtesting, worked for other traders, and still did not work for you, this video is for you. You are not broken. You are not unlucky. And you are not stupid. What you are experiencing is not a technical problem. It is a psychological problem. Today, I want to explain why profitable strategies fail in real life, what separates consistent traders from struggling traders, and how you can shift your mindset to become part of the small percentage that survives and grows in this market. If you are serious about mastering trading psychology and building long-term consistency, subscribe to Bull Mindset. This channel is about controlling your mind before the market controls you. Let us start with a hard truth that most traders do not want to hear. A profitable strategy does not guarantee profits. A strategy is only a tool. It is not a solution by itself. Trading is not just about charts, indicators, or entry rules. Trading is a human activity, and humans bring emotions into every decision they make. Fear shows up when price moves against you. Greed shows up when price moves in your favor. Impatience shows up when nothing happens. Ego shows up after a few winning trades. You cannot remove emotions from trading, but you can learn to manage them. Most traders never learn this, and that is why they fail. A strategy works on paper because paper does not feel emotions. Backtesting does not feel pressure. There's no fear of loss. There's no anxiety. But live trading is different. When real money is involved, your brain reacts differently. Your heart rate changes. Your thoughts speed up. You start thinking about money instead of execution. Doubt enters your mind. And suddenly, the same strategy you trusted yesterday feels uncomfortable today. This is where execution breaks down. Most traders do not fail because their strategy is bad. They fail because they cannot execute the strategy consistently under emotional pressure. They hesitate to enter trades even when all rules are met. They close trades early when price pulls back slightly. They move stop losses to avoid pain. They revenge trade after losses. They overtrade after wins. Over time, these small emotional decisions destroy their edge. Professional traders understand something very important. They do not look for perfect strategies. They look for strategies they can execute consistently. They understand that consistency is more important than perfection. The market does not reward intelligence. It does not reward excitement. It does not reward predictions. The market rewards discipline. The market rewards patience. And the market rewards emotional control. One of the biggest psychological challenges in trading is accepting losses. Losses are normal and unavoidable part of trading. Even the best strategies in the world have losing trades. Professional traders expect losses. They plan for losses. They accept losses calmly. But most retail traders treat losses as personal failures. They feel attacked by the market. They feel embarrassed. They feel frustrated. They feel the need to win back what they lost. This emotional reaction causes them to interfere with their system. They try to avoid pain instead of following their process. They forget that losses are simply the cost of doing business. When you truly accept losses, your mindset begins to change. You stop trying to avoid losses. You stop taking losses personally, and you start focusing on execution instead of outcome. This shift alone can dramatically improve your trading performance. Another major reason traders fail is inconsistency. A strategy only works over a large series of trades. No strategy wins every trade. No strategy avoids drawdowns. But many traders judge a strategy based on one or two outcomes. If they lose, they doubt the system. If they win, they feel overconfident. They start modifying rules. They adjust targets emotionally. They change time frames. They jump from strategy to strategy. And then they wonder why their results are inconsistent. You cannot expect consistent results from inconsistent behavior. Professional traders follow their plan even when it feels uncomfortable. They understand that short-term discomfort is part of long-term success. They understand that consistency comes from repetition, not excitement. Ego is another silent account killer. After a few winning trades, traders start to feel powerful. They believe they understand the market. They believe they have found the secret. They increase position size. They take trades outside their plan. They break risk rules. This usually ends badly. One emotional decision can wipe out weeks or months of progress. Professional traders respect risk. They understand that survival is more important than making money quickly. They protect their capital first. They know that without capital, there is no trading. Short-term thinking is also a major problem. Most traders focus on today's profit. They focus on this week's result. They constantly check their account balance. They want fast money. But trading doesn't work that way. Professional traders think in probabilities. They think in months. They think in years. They care more about process quality than short-term outcomes. They know that consistency over time is what creates profits. Let me give you a simple example. Imagine two traders using the exact same profitable strategy. Trader A follows the rules strictly. They risk 1% per trade. They accept losses calmly. They journal every trade. They focus on execution, not money. Trader B knows the strategy but struggles emotionally. They skip trades because of fear. They overtrade after losses. They increase risk emotionally. They change rules often. After 100 trades, Trader A is slowly growing their account. Trader B is stressed, confused, and often close to blowing the account. Same strategy, different mindset. Here's another example. A trader backtests a strategy and sees a 60% win rate. Everything looks perfect on paper. The statistics look strong. The confidence is high. But when they trade live, the results change. They exit winners early because they're afraid of losing profits. They let losers run longer because they hope price will come back. The win rate drops. The expectancy changes. Why does this happen? Because emotions change behavior. The market doesn't change. People do. This is why trading psychology is more important than strategy. A simple strategy executed well will outperform a complex strategy executed poorly. Now, let's talk about how to fix this problem. The first step is shifting your focus from profits to execution. After every trade, ask yourself only two questions. Did I follow my rules? Did I control my emotions? Do not judge yourself based on profit or loss. Judge yourself based on discipline. The second step is learning to accept losses emotionally. Before entering a trade, say to yourself that you fully accept the loss if it happens. If you feel uncomfortable saying this, your risk is too high. Reduce your position size until losses feel manageable. The third step is building consistency through repetition. Trade the same strategy for at least 30 trades without changing rules. Do not optimize during this period. Do not adjust emotionally. This builds discipline and trust in your system. The fourth step is changing your identity. Stop thinking like someone who wants to win. Start thinking like someone who wants to execute professionally. Identity drives behavior. When you see yourself as a professional, your decisions improve naturally. Let me leave you with this final message. 90% of traders fail not because strategies don't work, but because they cannot control themselves. The market rewards discipline. The market rewards patience.
and the market rewards emotional control. If you master your psychology, almost any decent strategy can work. But without psychological control, even the best strategy will fail. This is what bull mindset is about: building traders who think clearly, trade calmly, and succeed over the long term. If this content helped you, subscribe to Bull Mindset. We are building the mindset required for consistent trading success. Trade calm, trade disciplined, trade like a professional. I will see you in the next video.